The biggest misconceptions in trading. Hey guys, welcome back to the channel. Today I'm going to expose one of the biggest misconceptions in trading that's holding so many people back, and it's the idea that technical analysis alone moves the market. Let me tell you, this couldn't be further from the truth. Currencies, commodities, and indexes are not reacting to your trend lines or Fibonacci retracements. They are moved by something much bigger, which is real world data and macroeconomics. Before we dive in, here's a quick disclaimer. I'm not a financial advisor and this is not financial advice. Trading is risky and you can lose your capital. Always do your own research and never trade with money you can't afford to lose. Also, make sure to stick around until the end because I'll share a free resource that has transformed my trading journey and could do the same for you. Why technical analysis isn't enough. Let's talk about technical analysis for a moment. Don't get me wrong, it's a fantastic tool. It helps you identify key levels, patterns, and timings and entries for your trades. But here's the issue. Markets aren't moved by your charts alone. They're driven by macroeconomic events like interest rate decisions, inflation data, and geopolitical developments. This is why you commonly hear traders say things like, my strategy stopped working, or I had to change my strategy. But what they fail to realize is that there has been a shift in market sentiment. Imagine being involved in the money markets, but totally ignoring things like monetary policy, fiscal policy, interest rates. Interest rates are set by central banks, banks that hoard gold and currencies. Banks invest heavily into the stock market, and these are the same assets you're trading on your laptop and your smartphone. Remember, what happens off the chart determines what happens on it. If you're ignoring fundamentals, you're missing the big picture. And in my opinion, you're putting yourself at a disadvantage as a trader. So, what actually moves the market? Let's break it down. So, you have interest rates. Central banks like the Federal Reserve or the Bank of England set interest rates that directly impact currencies, commodities, and indices. A rate hike often strengthens the currency because it attracts foreign investment. Economic data, reports like inflation, CPI, GDP growth, and employment numbers can significantly shift currency values. For example, higher than expected inflation can lead to expectations of tighter monetary policy, boosting the dollar. Geopolitical events, elections, trade tensions, and even natural disasters can trigger rapid market movements. A great example is how Brexit impacted the Great British Pound, or how oil prices affect currencies like the Canadian dollar. When you understand these fundamentals, trading becomes less about a guessing game and more about anticipating market moves. So, how I became consistently profitable. When I first started trading, I focused almost entirely on technical analysis. I spent hours perfecting my charts, drawings, trend lines, and finding support and resistance zones, order blocks, you name it. But the results, inconsistent at best. The game changer for me was learning to integrate macroeconomics into my strategy. I began paying attention to interest rates, inflation, and global events. For instance, I'd track how non farm payroll affected the US dollar and how rising inflation influenced gold prices. By combining this knowledge with technical setups, my trades started to line with the market movement. This approach didn't just make me more profitable, it gave me confidence and conviction in my trades. I wasn't irrational in the markets anymore. Instead, I adapted and flowed with it. So, how can you start using fundamentals to benefit you in trading? Here's a simple 3 step process. Number one, track economic calendars. Tools like Forex Factory or investing.com provide schedules of major economic events. These are your cheat sheets for what's coming next. Number two, learn key indicators. Understand what reports like CPI or GDP mean for the market. For example, a strong GDP report can boost the country's currency by signaling economic health. Number three, combine fundamentals and technicals. Use fundamentals to guide your overall strategy and technical analysis to pinpoint entry and exit points. For example, if you know the Federal Reserve is expected to raise rates, look for technical setups that align with that bias. The sooner you integrate fundamentals, the sooner you'll see your trading improve. So now, for those of you who have stayed until the end, here's something special. I run a free trading community where you can access daily signals for gold and the US 30. These signals come from experienced traders and they're designed to help you make informed decisions. Even if you're a beginner, you also get access to insights on macroeconomics and trading fundamentals. So you can connect the dots between the news and the charts. Click the link in the description to join for free and take the first step towards transforming your trading journey. Thank you so much for watching. If you found value in this video, don't forget to like, subscribe, and leave a comment. I'd love to hear your thoughts on today's topic. Until next time, trade smart and stay disciplined.